Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. You're listening to episode number 394. The title is Tips for Successful Retirement Investing. I think you're going to love this show. But before we get started, I always like to get the day started right by renewing our mind, and especially this time of year with Christmas upon us, this verse is just perfect. It's Isaiah 9:6. For to us a child is born, to us a son is given, and the government will be on his shoulders, and he will be called Wonderful Counselor, Mighty God, Everlasting Father, Prince of Peace. Why doesn't Santa ever get sick? Because he has good elf care. Elf care. I was at a conference recently, and one of the speakers was Apollo Lupescu PhD. And he really did a great job of taking some of the technical aspects of investing and just making them very relatable, very understandable. And so I asked him to be a guest on today's show. Apollo is a highly regarded speaker from Dimensional Fund Advisors, a premier global investment firm managing over $650 billion, that's with a B, in assets for institutional investors and clients of select financial advisors. Here are some of the topics that we cover in today's podcast. Interest rates that have been going up and up and up, and the impact that that has on real estate, and also the potential for a recession. Is this the right time to be investing? The difference between the stock market and the economy. How to get out of the worry game and what it means to have a good plan. What should investors do in a high inflation environment? What's the break-even inflation rate and why is it important? We discuss crypto and Bitcoin. We look at what history shows us about Republican versus Democrat leadership and investing in the stock market. And then what are some of the drivers of higher expected returns? Remember, articles, links, and resources are available at soundretirementplanning.com. Just click on episode number 394. Without any further ado, here is my interview with Apollo Lupescu. All right, it's my good fortune to have Apollo on the podcast with us. Apollo, welcome to Sound Retirement Radio.
Hi, Jason. Great to be here. Thank you for the invitation, and thanks to everyone for taking the time to listen to the podcast.
Absolutely. You know, this show I'm really excited about. There's a lot of concerns that people have in the world right now, especially people that are getting ready to retire. You and I met at a conference recently, and I just want to take you through some of the questions that we're hearing from people that are on this journey trying to make this transition into retirement, some of the concerns that they have. One of the first ones that I'm hearing a lot lately is the concern about the Federal Reserve increasing interest rates, the impact that that's having on housing, and the potential for us to end up in a recession. So would you take a minute and share your thoughts on that?
Yeah, no, it is. And you know, first of all, I mean, if you are closer to retirement, if you are in retirement, it's disconcerting to see that things are changing. You have inflation, and to your point, a big one is around the interest rates and what's it going to do to my nest egg, and also to being able to sustain my lifestyle for the rest of my life. And let's start with a question that you tossed in there, which has to do with housing and the Fed and the impact that it has on housing. And if you focus specifically now on the folks who are about to retire and the folks who are in retirement, this particular move that the Fed has been making lately has an uneven impact among this category of folks, because you have on one hand individuals who are still looking to buy a house, they're maybe renting. And those folks, if you are looking to buy a house, it's certainly much more expensive to take out a loan. It's interest rates are pretty much doubled over the past year or so. So it's certainly much more expensive to borrow, and that would increase the cost of housing. If you're a renter, it's not really clear at this moment that you are really impacted directly by this, particularly since a lot of these building owners already have loans on all those properties. So it's not that they need to refinance them. But what I think is really interesting, Jason, is that a lot of folks who are close to retirement and who are in retirement as well, they happen to have a home, or if they happen to have an existing mortgage on a home. As long as that mortgage is a fixed rate mortgage that they got a while ago, so it's not something they're getting this year, but they've got in previous years, or if the house is paid off, this particular move by the Fed, the increase in rates that you hear on the news, is not really impacting you right now. And I'm looking at myself. I happen to have a 30-year fixed. And with all the noise about interest rate increase, my cost in housing has not changed because I have a fixed rate, and that's the case. I have my mother-in-law who is retired, and she has the house paid off. So to her, all of this doesn't matter. So I think it depends on who you are in your cycle of lifetime savings. If you happen to have the good fortune of having a mortgage already or paying off, having a house paid off, this does not impact you at all, when it comes to your housing cost. It's the folks who are looking to get a house now. Those are the folks who might be impacted, or the folks who have what's called an adjustable rate mortgage, which tends to adjust along the way with the interest rates. Those certainly going to get hit. Now, the UK has a lot more of those variable mortgages that we have in the US. And in the UK, they got hit a lot more. But in the US, it just really depends in which category you are. So let's start with the housing cost.
So that is true. And in some ways, the rising interest rates is good for retirees, especially if they've been sitting on a lot of cash, because now they're actually able to earn a little bit of money on their money, which is a positive benefit. But, we know that the stock market tends to be a leading indicator. Would you say that the real estate market is a lagging indicator? So would we expect the housing market to adjust down after the fact that we saw the stock market adjust down in 2022?
I think that those are really important in terms of leading indicator versus the current indicator. So when we think about housing prices, they are really determined by this immediate set of events, by what's going on in the economy right now, because people's incomes drive how much they pay for homes. It's the economic production in the country. There are a lot of things that impact the housing prices right now, which kind of go along with the economy and interest rates at the moment. So I think in that respect, the housing prices tend to reflect what's going on at the moment. The stock market is actually a little bit different because even though as people look and say, well, economy and the stock market, aren't they the same thing? Well, they're certainly related, but they're not the same. And what's the difference? The difference is in something that he mentioned, is the difference is in the fact that the economy reflects what's going on at the moment, whereas the stock market relates to ownership in companies. And the value of an ownership in any company, whether it's a share of Apple or Microsoft or Google or Coca-Cola or McDonald's, the value of that share of ownership depends on the profits, the earnings that I expect the company to make. Because as part owner, I am entitled to part of those profits that the company makes. So in that respect, the stock market is not about the present. It's much more about the future. Because what the stock market participants or all investors are trying to do is assess what is the opportunity set for a company like Apple. Will they continue to make money, and how much money will they continue to make? And that's the role of the stock market, is continuously take all this information about a company, all the expectations, and really try to have an estimate of what do I think this is worth going forward. So in that respect, the stock market is a leading indicator because it is not about the present, but it's about the future. And sometimes you could be in a situation when economically it might look really good. If stock market participants see some dark clouds on the horizon, they might reduce the value of these stocks because they see that perhaps there are some headwinds, and they're going to reflect those headwinds before they even happen. And the converse is also happen. It's also true, Jason. If we are in a dire economic situation, and somehow we find ourselves as investors really questioning, is this the right time to be invested? Because it seems the economy is not doing really well right now. Well, again, the stock market and the economy, they're related, but they're not the same. And quite often, because it's a leading indicator, even as we are in a dire economic situation, it could be a recession. It's quite possible that the market might actually do really well because it's looking ahead and perhaps seeing the brighter days. And there are really great examples of this, of this seeming disconnect that actually makes sense. 1980. It was a terrible economic year, big inflation. We had high unemployment. We have low economic output, low housing starts, low retail sales, a lot of things that did look terrible in the economy. And if you're an investor, you kind of say, well, this cannot be a good time. Look how terrible everything is. Again, the market is a forward-looking exercise. And what the stock market perhaps saw in 1980 was that, hey, we're going to get through this, and there are really brighter days ahead. And by the end of 1980, the S&P 500, which is a broad measure of the U.S. market, was up 32%, more than three times the historical average. So if you're an investor, you might be puzzled. How come this happened? Well, again, the markets are forward-looking. In 2009 was considered at the time to be the worst economic year since the Great Depression. And the market bottomed out in March. And it was very obvious that the economy will continue to get worse. There's no doubt about it. And in fact, we did not get to the high unemployment of 10% till October. Yet by the end of 2009, the S&P 500 was up 26%, 26% in that year. So certainly when you look at those numbers, you say, well, how can the market do so well in such a terrible economic year? What the market's reflecting is what might come next, not necessarily what's going on at the moment.
The behavioral element of investing is so difficult for people. Sometimes it feels like we want to be rewarded for finding the bad news. It's like thinking about how bad things can get. And yet the economy and the stock market has been resilient for a very long time. David Booth, one of the founders of Dimensional, he recently wrote this. He says, "Our approach is to get you out of the game of worrying and guessing and having a plan that can provide peace of mind." In your opinion, what does it mean to have a good plan?
Yeah, I mean that's to me it's the beginning of the definition of a successful investment experience. Any successful endeavor really starts by understanding, what are you trying to accomplish? What are you trying to do there? You can have the nicest jet, you can have the G6, whatever the newest jet is, and you say, great, I'm going to take off, and I'm going to fly that jet. I think that if you do just simply do that, it's not going to be really successful. The first thing you need to do is find out, where am I going? Where am I going to land? And I think it's the same with investing. A plan is really telling you, what are you trying to accomplish with your money? It really takes account of your own personal circumstances. What is your definition of success? Is it making a lot of money, or is it having time with the family? Is it, do you have other assets? Do you have a pension? This plan has to account for everything. And to me, the plan is the beginning of a successful investment experience. And that's, I think, a lot of what David is talking about is, do you have a plan?
Yeah.
And even the housing, you talked about the housing. We talked about the housing and the impact of interest rates. Well, that element, housing, is a big component of somebody's budget. That typically tends to be part of the plan. How much money do you need? Well, if you're going to pay off your mortgage, by the time you retire, that plan takes that into account and invests perhaps differently than somebody who might not. So to me, the plan, and this is what you do, Jason, is an incredibly important part. It's probably the most important part of getting started with investing, is having a plan.
Well, it's funny when we talk about housing, people see the market go down 10%. They're like, oh, I got to sell. I got to get out of this. It's just too much volatility. But if they watch the value of their house fall by 10%, nobody's saying, hey, I got to sell my house. I got to move.
Right. And do it every day. Yeah, absolutely.
I wanted to ask you about inflation. Inflation's running at all-time highs, over 9%. It's got people concerned. There's been some reports recently that inflation's coming down. Talk to us about inflation. How can people handle inflation? What should they be doing to deal with inflation? And is inflation a long-term concern? Are we going to have to worry about 10% per year, for the next 20 years? What are your thoughts there?
Yeah, so it's a very interesting, because I think inflation is the one thing that all of us see it. It's very visible to all of us. When you show up at the gas pump or the grocery store, that kind of strikes you. It's no doubt that it's here. And it's concerning because inflation means prices go up, meaning that if I have some money into my account, I cannot buy as much because prices are higher, whether it's gas or milk, whatever the case might be. So that is really hurting people, particularly if you're on a tighter budget. That inflation tends to really hit you hard, because you're used to buying a certain amount, even if you're not splurging. That's if you're just covering your bare necessities, and now it's harder to do that. That's concerning. So when I think about inflation, the first of all is that we are running this year at a higher inflation than the historical norm. In other words, inflation has been with us for many, many years. In fact, if you look at the economic history of the country, we've had inflation for running at about 3% on average per year over the long term. So that we have had inflation.
Some inflation is healthy.
Exactly right. So there's a certain level of inflation, and it's been present with us. Now, what's interesting is that we have not seen inflation this high in a very long time. The last time that we saw inflation in the range that we are today was in the early 70s, and actually throughout the 70s and into the early 80s. The circumstances that led to that high inflation were quite interesting, because it started with, Jason, was something that today would be really hard to fathom. But let's just tell the story of what happened. In the early 70s, economists pointed out that as the economy is getting bigger, you have more people in society, more economic production. We could not print dollar bills to sustain this economic activity because we had something called the gold standard. And the gold standard basically said that in order to print another dollar bill, you need to have gold in the bank. And that gave a lot of people confidence that the dollar has value because, look, it's backed up by gold. And in the 1970s, again, this realization came about. And in 1971, President Nixon actually did something tremendous. He actually cut the link between the dollar and gold, which was a positive in the sense that it freed up our economy to grow. What I think it's important to acknowledge is how it must have made people feel. Because if you're being told in 1971 that the government can now run the printing machines day and night, there's no backstop, there would be a lot of anxiety about the value of a dollar. Is this going to be worth anything? Because, hey, the government just print money. There's nothing to stop them from printing as much money as they want. So there's a lot of, talking about the behavioral aspect. Can you imagine today being told that as opposed to past, the dollar can just, the government just print money? Mm-hmm. How would we feel today? Mm-hmm. It would just be scary. And a lot of folks were concerned about the value of a dollar. On top of that, there was the OPEC oil embargo and the energy crisis of 73, 74. We had a global drought, and which led to very high food prices. We had this witch's brew that led to very high inflation in the early 70s. And what's interesting is that in the early 70s, there was a realization that one way to fight inflation is by reducing the pressure on prices. And one way to do that is to make it more expensive for consumers and companies to borrow. Because if mortgages go up, you have less money to buy on other things. That reduces pressure on prices, and that can accomplish the reduction in inflation. So the Federal Reserve then had stepped in to do exactly that. Trouble is that as they stepped in, they also reduced economic activity, and then when they saw that, they reversed course, and they reversed the increases in rates, and then inflation stayed high. But Jason, what I think it's crucial to point out is that inflation is not just the supply and demand, the economic part of it. And it come back to what you said. There's a behavioral component to this, because if you are a union, or if you're a supplier and you're not convinced that the Fed is serious about fighting inflation, and you have to negotiate a union contract, for example. Well, if you think inflation is going to be high and your expectation is that inflation is going to be high over the next few years, well, you're might bake in a 10% per year increase in wages for the employees, for the union members. And at that point, the expectation of high inflation becomes a self-fulfilling prophecy. And I think that was a big issue in the 70s until Paul Volcker, who recently died, came along as the Fed chairman, and he said, no, we're going to stick with these high rates, irrespective of how much economic pain we might cause, because this vicious cycle of high expectations of inflation and then high inflation might be a lot more damaging. Mm-hmm. And what was interesting is that he stuck with it. We did get into a recession. It was not pleasant for a short period of time. But what came at the back end of that were 40 years of really minimal inflation, really constrained inflation, because everybody really had the expectation now that if inflation gets higher, the Fed will do the same thing that Paul Volcker did. So fast forward to 2022, we are in a situation right now where the Fed is faced with the same sort of trade-off. You could raise rates and perhaps go into a recession, and that's a possibility. Or you could cut the rates and perhaps have a little more inflation, but not cause economic damage at the moment. So I think what the Fed is doing right now is really signaling that we are very strong on our path to stick with high rates as long as it takes to combat inflation. And that's the message. And the message seems to resonate because right now there is a metric that a lot of bond investors are watching. It's called the break-even inflation rate, which reflects what is the bond trader's expectation of inflation over the next 5 years, for example. And right now, that metric stands at about 2.3%. This is as of late November, which is 2022, which is just around the Fed's target and below the long-term average. And another way to see that, if you are buying bonds, the long-term bonds, they actually have a lower interest rate, the lower yield right now than the shorter-term bonds. So the expectation is that perhaps over the short term, we might have a little bit of residual inflation, but then once you look out a little bit beyond the short term, inflation is going to be kept in check. So that's the market signal. So that's not my personal opinion. This is what the market is signaling right now in the way that it prices assets.
An inverted yield curve, along with the fact that we're seeing inflation maybe coming down a little bit by some recent measures, would all be positive signs for stocks if that were the case, because then there's the potential. Now, it seems to me that the market has become incredibly dependent on Fed actions the last couple of years, and it does make you wonder how healthy that is. But I wanted to come back real quick because you were talking about leaving the gold standard. And one of the things we see in the world today is a lot of people talking about that is the reason why something like Bitcoin needs to live in the world, because there's a limited amount of this digital asset. And it's rather than just having a promise to pay, people are going to put their trust in computers that say, hey, you should own Bitcoin. So I'm curious to know your thoughts about Bitcoin as a currency, Bitcoin as digital gold, and just some ideas about crypto, what people should be thinking about. What are your thoughts there?
It's so interesting because people did look at gold and Bitcoin in a similar way, saying scarcity. In other words, it's not an unlimited quantity that creates value. And there's certainly, if you look at wine, the fewer bottles of a good wine you have, the more expensive it is. When it comes to running an economy, the evidence that we see so far is scarcity as opposed to being a benefit. It can actually be a limitation. That's exactly what happened to gold.
Right.
So if you're saying that Bitcoin is the future, well, there are 21 million Bitcoins. That's the most that we'll ever have. And if you imagine the planet continues to grow, the population, the level of economic production and so forth, how can you possibly imagine that you're going to be limited with the same amount of Bitcoins? I mean, it just doesn't make, even like intuitive sense, it doesn't make. Like, I don't see it I'm
not personally a fan of Bitcoin. I just wanted to hear your thoughts on it because it's something that people talk a lot less about it today when it's down to 16,000 compared to when it was at 60,000, but.
Yeah. So let's put some background on it, because I think it's still, I think John Oliver said it really well, that crypto is everything you don't understand about money combined with everything you don't understand about computers. What can go wrong? There's still a lot of confusion about Bitcoin and crypto. So let's quickly kind of, in a minute or two, kind of revisit this concept. So this comes back to about 2009. And in 2009, we're in just around the financial crisis. And there was a lot of skepticism and distrust in the U.S. financial system. And at the time, the idea of electronic money was not really new. But what this one individual or a group of individuals, it was an anonymous Satoshi Nakamoto, nobody knows exactly. This individual group of individuals published a really short 8-page white paper in which they laid out a way of organizing tokens and basically payments between individuals without relying on a centralized unit. And also in a world where you don't trust anybody, because at the time, like, nobody trusted the bank. So can you have a way of dealing with payments among people that is much more direct, doesn't rely on central units, and it's really you don't need to trust anybody. So what they envision is something that has two different components to it. The first one is the token itself. And I call it token because it was never called a currency. It's a token. It's just like when you go to Vegas and you got a chip, you could have real money value, but it's a token. It's not a real currency. And they invented Bitcoin and put the name of that. But the second thing that was really clever, and I do believe it's here to stay, is the way to keep track of ownership of these tokens. In the bank, Jason, now
the blockchain.
Yeah, exactly. So the blockchain is the name of it. Right now, if I have an account at a bank, the bank has a centralized ledger that keeps track of everybody who owns and the amount of money they own in that bank. and they control that centralized ledger. Nobody can see it. It's only them, and they maintain it. And I have to trust them. They're going to do a good job maintaining it. Now, what blockchain did is create a decentralized way of keeping track of all these ownership of tokens. So it basically said, well, let's just put the same ledger, instead of being centralized, hidden, let's just put the same open ledger on thousands, if not tens of thousands of computers, maybe millions of computers around the world. And all these computers simultaneously will somehow keep track of the ownership and all the transactions that have happened at all times in this token, in this Bitcoin. And that's the idea of blockchain. And blockchain, a lot of people do believe that it has the potential to improve a lot of the things that we do, to make it a little more faster, just a little more transparent. So there are really benefits to this. And Walmart, for example, recently, Walmart Canada, they use blockchain technology to improve their operations. So there's certainly, I have no doubt that there are clear benefits to the blockchain technology. Right. When it comes to Bitcoin, at the time, because of the skepticism in the financial systems, well, why can't we have a way of payments among individuals, a currency through this token of Bitcoin? And that was the idea that was put forth about 13 years ago. And if you fast forward 13 years, is Bitcoin a currency? The answer is absolutely not. A currency has to have three features. The first one is medium of exchange. In other words, people accept it. I don't know how many people accept it. I've never bought anything on Bitcoin, and even people who own Bitcoin, they don't buy things with it. Secondly, it's a store of value, meaning that what you have in your account today can roughly buy the same things tomorrow or the day after. And in the fluctuation of value of Bitcoin, that's not the case at all. And that's not what happens with your checking account. And then thirdly, it is a unit of account, meaning like prices get quoted in that currency. And there's none of that. So let's just make it clear. It's not a currency. One particular country tried to make it a currency, and it's an absolute failure. That's El Salvador, a tiny economy, and they just tried it because their own currency was in shambles. And right now, even if the government kind of pushed it on people big time, I think the statistics that I've heard is 85% of the people still use dollar bills, and the 15% is just more to take the money out that was given for free. So in other words, I don't encourage people to look at it as a currency, but then it did draw individuals to the dream of being an investment that can make you money. And they said, "Why not just
speculation?"
Exactly.
I like to think of Bitcoin and crypto as speculation, not investing. Or maybe I even say I think of it as gambling. Like going to the casino.
It is. And let's just say why, because you're absolutely right. It's exactly speculation, but why? When you're thinking about buying, let's say, an apartment building, well, you look out there and you say, I have 4 units, and each unit might generate $2,000 a month in rent. So I got $8,000 in rent per month. So you do that per year, it's roughly $100,000 in rent. So I can collect $100,000 in rent. And if that land, whatever the owner of the building wants to sell that building to me for $200,000, well, that's a really good deal, because I get $100,000 per year. I'll pay it off in 2 years. Great, I'm in. It's a good deal.
Right.
In other words, I can value, is this a good deal or not? If the same owner is now asking me $20 million for that, I'll be like, hang on, little buddy, that's not going to work out very well. So I have a way of valuing and determining as an investor, is this a good deal or not? Because there's a production capacity. There's something that generates revenue.
Right.
It's the same with stocks. When Apple sells all the iPhones, for example, well, you kind of say they have a margin, a profit margin. How much money do they make? And I have a way of valuing, given the profits that they make and what I'm entitled to as a single shareholder, is this a good deal or not? Bonds are the same way. So when you look at the investment world, the biggest thing is being able to look at what is the productive capacity of that entity, and then can you value today, is it a good deal or not? And you might make assumptions, whatever, but you know that they're producing something that might generate profits. In the case of Bitcoin, there's none of that.
No.
There's no way to value, because even people who buy Bitcoin, they say, well, why are you buying it? Because I think somebody else is willing to pay more for it later. If you ask them why, nobody can tell you why.
Right.
It's just that, and that's exactly what you were just mentioning. It's the pure definition of speculation. I have no idea why, but I'm going to buy it, say a prayer and hope that it comes through. But that's not the definition of investing. Investing is about being smart, analyzing numbers, crunching the data, and ultimately valuation is a huge deal.
Yeah.
And that to me is the reason that I would not put anywhere close to on the same level investing with Bitcoin.
Right.
It's like we talk about bottle of wine or baseball card. If you draw pleasure from having that, if you draw pleasure from talking about it, perhaps you want to just get a couple of Bitcoins for the fun of talking about it and being social. You're part of a community that's enterprising and cool and all that, but do it for the right reasons. Do it the same way that you buy a baseball card.
Yeah,
You don't want to put your family's future in the baseball card.
No, you don't want to gamble your family's. You don't want to go to the casino with your retirement account. That's a bad idea. I want to get off this Bitcoin crypto thing, and I want to ask you about bonds. Typically, especially as people get ready to retire, they think of a bond as stability. They think of a bond as income. And in today's world, in 2022, bonds in some instances have been more volatile than stocks. So talk to us about your thoughts on bonds and what should people be thinking about going forward as it comes to fixed income and having that ballast in their portfolio.
Right. So let's talk about bonds. So bonds are different than stocks. We all know stocks are about ownership in companies, and the value of the ownership comes from profits. Profits fluctuate, and there's no way of telling what the profits could be. So there's a lot of uncertainty associated with the stock market, and we see that in the volatility, in the movement up and down to reflect these changes in expectations for profits. Bonds are a form of lending. Us as investors, we have capital. And let's say, for example, the U.S. government, they would like to build something and they can generate revenue from taxes. They just need the money now. So they come to us as investors and say, listen, if you're willing to, let's say, lend me $1,000, we can write up a contract. And in that contract, we specify the interest rate that you receive on your money, on this loan that you give us, and for how long you get that interest rate. And at the back end, you get your money back. That is the idea of a bond. So as opposed to the stock market that has no clear definition of what am I going to get, there's a very clear payment to investors in bonds. And U.S. government borrows money this way. A lot of other foreign governments do it. A lot of companies borrow money through the idea of bonds. So as opposed to the ownership piece, this is about lending. And there's a lot more clarity in terms of what you do and what you get. So this year, as you said, bonds have kind of sent some warning signals to investors saying, wait a second, I'm losing money. When I look at my statement, I hear that bonds are losing money. So let me start by clearly defining how are people losing money. If you had, let's just toss it $100,000 just because it's a nice even number. At the beginning of the year, you said, okay, Uncle Sam, I'm going to give you $100,000. And they put up a contract that said, okay, for the next 5 years, I will give you 1% on your money, which is roughly what the interest rate was at the beginning of the year, roughly speaking. And at the back of the 5 years, you get your money back. And then you can reinvest it and maybe do the same thing. If you had done that at the beginning of the year, you are not losing money because the government is not paying you. The government will, it's expected to continue to make that payment. So if you were told you're going to get 1%, you would get, exactly what you did. You would get $1,000 a year, 1% on that initial investment that you made with the U.S. government when you give them the money. So you're not losing money. If you're holding on to that bond and you bought that bond from a trustworthy entity, then the idea of losing money is not because you're not going to get paid. You will continue to get paid that 1%. Now, fast forward towards the end of the year, interest rates in the economy have gone up. Now, the same bonds issued by the government, instead of paying 1%, now pay 4%, which is bad for the government. It's good for you as a lender. So now, if you buy these new bonds, exactly the same as the beginning of the year, 5-year bonds, instead of getting 1%, you get 4%. And here's the thing. This opens up is an interesting choice for you as an investor. If I stick with my 1% bonds, great. I have no loss. I hold on forever. I'm good. And let's say you have a 20-year time horizon, you'd be totally fine. So your bonds stayed at 1%, you would make over the next 20 years in these 5-year bonds roughly about $122,000 between the principal repayment and the interest. Now, here's the thing. The option that it opened up for you now is that you could sell the bonds that you bought at the beginning of the year that pay you 1% and buy the 4% ones. Thing is that if you go in the market and you say, hey, I have some bonds to sell, the US government, really trustworthy, they pay 1%. Investors are going to look at you and say, wait a second, I can get exactly the same bonds now paying me 4%. And if you want to sell them, I'll buy them from you, but I will not pay you the full value of those bonds. Perhaps I'll pay you, let's say, $86,000. That's where the loss comes in. If you were to sell the bonds, you would see this loss. And that's what's reflected in a lot of the statements. If we were to sell these bonds. Now, why would anybody want to sell the bonds and realize a loss? Well, the reason they might want to do that is because you now take the 86,000 and you reinvest it, but at 4%. So the question, are you better off sticking to the 1% for the next 20 years? Are you better off buying the 4% bond and then staying at 4% for, let's say, the next 20 years? And what the mathematics of bonds are telling investors is that if you have a 20-year time horizon, so your time horizon is greater than the maturity of the bond, you are better off selling your lower paying interest bonds, buying the new ones with a higher rate, because by the end of the time horizon, let's say the 20 years that you have ahead of you, you're going to be better off. So when investors are confronted with these losses, I think there's a really significant upside. And the upside is that in the short run, you might be underwater for a little bit. And at some point, you're actually going to be breaking even relative to just holding the old bonds and actually get ahead. So to me, it's one of those good news, bad news. The bad news that you might see a loss. The good news is that if you actually take and reinvest at the higher rates, and people were complaining about low rates for a long time, then you are better off. And Jason, last thing, let's put the shoe on the other foot. Let's say that you did not buy any bonds at the beginning of the year, say, I'll wait. And now you bought the bonds at 4%. And you spend $100,000 on the 1%, on the 4%. And you have these 4% bonds. And somehow, soon enough, the Fed changes course and rates drop back to 1%. Well, you have a choice again. You could hang on to your bonds, and that's fine. Or you could sell your bonds, and you would see a great return on your bonds. You'd be really happy. Look, I made maybe 20% on my bonds if interest rates were to drop because my bonds are worth more. They're more valuable. The trick is that at this point, there's a trade-off. You made this 20% and you feel really good about it. And you have now you have now $100,000 to invest, $120,000 to invest, but you are now investing it at a lower rate at 1%. Are you happier with the bump that you saw immediate in your account, but then for the rest of your time horizon, you don't make as much money? So you could see a positive, but again, be careful, because if the positive is there, it might just reflect that the reinvestment rate might be a lot lower. So it's a really interesting dynamic right now about what it means to lose money in bonds.
And it's a tricky environment because when you're broadly diversified across asset classes and sectors, there's a good chance that you're going to have something in your portfolio that's doing well and something that's not doing well. And this is an example, 2022 is an example where you've got a lot of stuff that's not doing well, but the bonds that have historically been that stability for you have not done well. And so in some instances, people say this would be 2022 would have been a really bad year to retire with stock market volatility, high rising interest rates on bonds, and high inflation. It just made it a very challenging year for retirement. I want to ask you, because we just came through an election, and I wanted to ask you about how elections and leadership in Washington, D.C. impact and affect investors. Because one of the risks, Apollo, I've seen people do this both ways. When President Obama was elected, that was some people did not like President Obama. They said, I want to go to cash. The economy is going to fall apart. And then the stock market went up for 8 years. And then when President Trump was elected, people said, I don't like President Trump. They sold everything. They went to cash. And then the stock market went up during President Trump's time in office. So talk to us about leadership in Congress, how that impacts the stock market.
Yeah, no, it's so interesting because, as you said, we went through an election, and what we see over and over is that elections are deeply emotional because, Jason, it touches on our deeply held beliefs as individuals, our values, our identity. Because of that, it tends to be very emotional. And I don't think it's a problem because that's what makes us human. So the fact that we have emotions based on these social issues, whatever views we might have, I think it's a perfectly legitimate thing to have as a human being. And the way that we encourage people to express these emotions is by voting, by getting involved. And that makes a lot of sense to me. What has been interesting is that quite often, as you said, people take those emotions and they move them into the area of investing. What's been fascinating is that what we wanted to do, and I think that good financial advisors like you and managers like us, we want to acknowledge these emotions that people have and not make anybody feel good or bad about their views, encourage them to express them the right way. And at the same time, we want to be very pragmatic about making decisions when it comes to their assets, to their money. Mm-hmm. And we want to make those decisions not based on emotion, but really based on data and evidence. So to me, the starting point of any discussion around politics is distinguishing between the emotions that they trigger, as you mentioned, and also being able to look pragmatically at the data and evidence. And what do we see with respect to politics and the market? And here's what's been interesting to see is that we have looked at this, whether it's around midterm elections, whether it's around who's in control of DC, the political party in Congress or the political party in the White House. And over, and I'll give you some examples of data. What we see is that it is not evident that in any way one party or the other is better or worse for the market. One policy or another is better or worse for the market. So let me just go back and give you some examples to back up these assertions. So if you look at policies, and people say, well, there are policies coming from DC, and there certainly might be some winners and some companies that don't benefit from this. And a good example is not too long ago, around 2017, there was a push to help the domestic steel industry. I remember, if you remember, that there was the big discussion around how do we help the U.S. steel manufacturers. You look at U.S. Steel, which is a company that really bears the name of the industry, and as these discussions went on, the stock price did go up, and then their tariffs were put in place about March of 18. And you look what happens to the price of U.S. Steel afterwards. It's really went down significantly afterwards. So it did not seem that even in an obvious case, when the country is really trying to get behind a U.S. great American company, that's necessarily going to translate into success for investors. Because the intuition might have been, well, now they're helped. Now, obviously, they're going to make more money, so the value is going to go up. It did not appear to be the case. Policies that a government, like let's say the president, you talked about the president, you look at President Reagan, and let's just take a president that's well known for business and helping with taxes and a lot of things. In that case, you look at as an investor, you might say, well, if you have a business friendly president, the market ought to do well. And in fact, for the 8 years in office, the stock market during the Reagan years went up by 15.8%. That was the annualized return during the 80 years in the S&P 500. And then you take another president, as you said, President Obama. So let's just look at President Obama. The priorities were more on the social side, Obamacare and so forth. And as an investor, you might say, well, it doesn't seem like it's that business friendly. So what should I expect? Well, during the 80 years of the Obama years, the market went up on average annualized by 16%. So you have 15.8 or 16. I mean, they're virtually identical. So it's kind of hard to say that the policies of any one president really make a big difference in terms of how the market does. And then, but to me, the numbers that really came so evident was where they came in about January of last year, because there was a special election in Georgia, and in January it was announced that the Democrats won, so they would have unified government control, meaning they controlled the White House, the Senate, and the House. And at that point, it just became a natural experiment. When you have a unified government control and, one party controls the White House, the Senate, and the House, how different are the results in the market? So we actually went to work and we looked at the data, and Republicans ended up actually having that control for 13 years when you look back to the 1920s, since we have good data in the U.S. stock market. And the average, Jason, it's important that the average return per year during these 13 years of Republican unified government control was 14.52%. That was the number, because that's going to allow us to now check, well, did the Democrats have, and how did the market do relative to that 14.52? Turns out the Democrats also had this unified government control, but instead of 13 years, they had it for 34 years. And again, I'm not going to try to kind of like the drum beat and tell you the number, but what the numbers show is that during the Democratic government, unified government control, the stock market went up on average by 14.52%. Mm-hmm. It was identical to the second decimal. Mm. So to me, this is a natural experiment that really ultimately highlighted sort of this idea that it's just like the icing on the cake. It's like it's identical to the second decimal. Mm-hmm. And then you ask why. So what's the intuition? Why should I expect this result? Well, if you think about, come back to Apple. I just pick on Apple because a lot of people are familiar with their products. They're not any better or worse than Microsoft or anybody else. But it's just we're familiar, or Google for that matter. If you think of Apple, Google, Microsoft, and you ask the question, where's their value come from as a company, as a stock? It's from the profits they expect to make. So if you think of profits, again, profits and earnings being the name of the game, what matters more for these companies? The products they have, the services, the strategy, how they execute it, what competitors do, or who's in the White House? What is likely to be the main driver of their profits? And what you find over and over is that politics or the Fed or other things that are right now in the forefront of people's vision of the market, all of these are certainly variables that matter. They all matter. The war in Ukraine matters. Inflation matters. The Fed matters. The politics matter. They're all variables that impact the stock market. We have not been able to find a single primary variable that you can link the performance of the market with that particular metric. It's the same with the Fed. We could not link the performance of the market with the Fed moving rates up or down, with politics having Republicans, Democrats, with the presidents or their policies, with policies. There's no link that says this is a primary variable. They're all variables. They all matter. And by the time you put them all together in this blender, and you mix in the sugar and the flour and the eggs and the butter, you're not going to be able to distinguish what made the batter. They're all blended in there. And to kind of say, aha, I see the yolk in there, I think that's not really a productive way to look at it. So that's the idea. They're all variables that matter, but there's no primary one. Don't point your finger and say, aha, I know this, then that's going to happen in the market. It's not the case. There are too many ingredients in this mixture of what drives the market returns.
Yeah, what we need to do is get people focused on being long-term investors, focused on decades, not what's happening over the next couple of days or weeks or months. And the market has proven to be incredibly resilient. And whether you talk about the geopolitical concerns that we have, or the interest rates, or the Federal Reserve, or the who's elected to Congress, when you become an investor, you have to become an optimist. You have to believe that the future is going to be better than the present. And unfortunately, in the world that we live in right now, Apollo, there's so much emphasis on the bad news. And maybe this is a social media thing. Maybe that's what gets the most traction. But it's a challenging time to try to get people to focus on the good that is coming, not focus on the bad that they think could happen.
Absolutely. And and I cannot echo that enough, because the real source of optimism is not just that we like to be optimists. I think, to me, the real source of optimism is the fact that we live in a free market society, that these companies are free to pursue their endeavor. And I would really, and I'm quite certain that in free markets, companies will try and find a way to make it work and make money, irrespective of the conditions in front of them. They'll find a way to make it work. And not every day. There are going to be times when they're going to stumble. But by and large, as a market, as an economy, that's the hope. The hope that I have is not just because I'm an optimist. It's just that in free markets, companies will find a way to make money irrespective of the conditions. Look in the pandemic. When distilleries couldn't sell whatever they're selling, they were brewing hand sanitizer because that's what sold. In the war, World War II, GM and Ford, they were making planes and tanks instead of cars. That's the idea of a dynamic economy, an innovative economy, and that's really the source of optimism. As long as we have that fundamental premise, I do think that the markets are incredibly resilient, because companies are resilient, and companies are resilient because people are resilient. So anyway, so I wanted to echo what you said, because it's so true.
We've talked about the things that we have not been able to identify any link between the performance of the stock market and things like who's elected to Congress or inflation or interest rates or some of these other things. But there have been some elements that investors can look to try to pursue higher expected returns. Can you share with our listeners what the data reveals about investors, long-term investors that want to pursue higher expected returns? What are some of the drivers to those higher expected returns?
One thing that academics and practitioners have tried to do is really form a good expectation about the market. And initially, people were looking at individual stocks. It became apparent that this is getting too competitive to say that anybody can get better or faster information or process it in a superior way at the individual stock level. And what academics really moved on and honed in was a different way of trying to identify the dynamics in the market, which was not at the individual stock level, but much more at a larger groups of stocks. And that became known as asset class investing. The most popularized one is around sectors that you have technology, financials, and so forth. And sectors are certainly a consideration. When academics and when Dimensional looked at sectors, they don't appear to be a variable that drives returns. They're more something you have to be aware and mitigate the risk of maybe being too concentrated. But the three main distinctions among larger groups of stocks have been actually quite interesting, and they've been so well researched for the past 40 or 50 years. So the first one is the size of a company. When you think about the market, quite often the media talks about the Dow Jones, which is a subset of 30 stocks at about 3,000 in the U.S. market, or the S&P 500, which are the largest 500 companies in the U.S. But as I said, there are roughly about 3,000 companies that you can buy ownership on a stock market. And if you think of a large company, and let's just associate the idea of a large company with McDonald's, well, that's the poster child, for example, for a large company. What's a small company? Well, there's another chain called Shake Shack. I'm not sure if there are some in your neck of the woods, but it's a burger joint that's publicly traded, and it's certainly not as big as McDonald's, but it is selling the same burgers and fries. It's kind of like McDonald's. It's just that it's a smaller burger chain that's publicly traded. So what we found is that by and large, if you look at all these smaller companies, these companies do have perhaps a greater potential to grow. It's easier to see Shake Shack doubling in value and not value, but in operations and getting twice as many stores than it is McDonald's. So it's conceivable that smaller companies can perhaps have a larger growth opportunity. They're not as mature. They don't have the track record. And in that respect, their cost of capital for investors, it's presumably a little bit higher. And the cost of capital, meaning is our return as investors. So there's economic evidence and data to suggest that small companies behave differently than large, and they have a higher expected return. It's just that on the media, you only hear, not only, but most often you hear only about the S&P, the Dow, which are just the large companies. Keep in mind, there are about 2,000 other smaller ones that are traded in the country that you just don't hear about. And those actually historically that they've had a higher expected return. So that's kind of one distinction. The second distinction among large and small is around valuation. We talked about earlier about valuation, which means how much are you paying to get some accounting fundamental. So if you're thinking like, okay, so this company has some assets and some liabilities, and when you think about paying the liabilities, what are last assets left over? That's typically called book value. At a very high level, that's called book value. So if you wanted to buy, let's say, $1 billion in a company's book value, how much are you paying for that $1 billion in book value? If it's a lower cost, let's say $2 billion, for example, just to make a point, well, that's a relatively low cost versus a company that to buy the same $1 billion in assets in book value, it might cost you $20 billion. So the relative price of how much does it cost you to buy the market price relative to an accounting fundamental, that's the idea that distinguishes value stocks, which are relatively low cost, from the more expensive counterparts called growth. And historically, what the data shows is that the lower price value stocks, they tend to outperform the more expensive counterparts called growth. So now you have a second distinction. So if you're interested, you have, small outperforms large historically, has outperformed large historically. Value has beaten growth. And then the third distinction has to do with the profitability of a company. The companies that are highly unprofitable, they tend to continue to stay highly unprofitable, and the companies that are profitable, they tend to stay profitable. And again, it's important to distinguish what profitability is, and I don't want to get into too many details. Certainly Jason can answer that. What I think it's important is that the high profitability companies, they tend to have a higher expected return than the lower profitability. So if you create now almost like a matrix of dimensions, these three, the more you emphasize small, the more you emphasize value, the more you emphasize high profitability companies, then you are giving yourself as an investor a diversified way of capturing higher expected returns in the market. And that's what advisors do. That's exactly we don't suggest that there's one optimal allocation among a list. This is something that you need to have a plan. You need to sit down with an advisor and figure out exactly how much do we want to move into each direction, whether it's small, value, profitability, and how do we do it in the most optimal way? Because you have to also pay attention to taxes and cost and a lot of other things.
Apollo, I've sure enjoyed our time together. I know that we're running out of time, but I just wanted to finish up with your final thoughts. Is there anything you want to leave our listeners with today? I know that they're going to love this interview, but any final thoughts as we finish up?
It's so interesting because, Jason, I've worked with, so many investors and financial advisors, and I've come to be just an incredible believer in the value of an advisor, and the fact that when you are confronted with this incredible challenge of managing your financial life, it can be hard, not just because of the emotions. It's just the time that you have to spend and invest in it. It's the fact that you want to get the whole family involved. So probably, I think the final thought would be, it is so important to be educated and understand at an intuitive level what's going on, and take the intellectual capital to be informed about the markets and what's going on. And at the same time, just really work with an advisor who can create a personalized, comprehensive plan, because that is, to me, the definition of success. It's not the shiny stock, the shiny mutual fund. It's much more of, if I take off from my shiny jet, where am I going to land? What's my flight path there? And that, to me, is the most important decision that you have to make in investing. If your destination is too far, you run out of gas, who cares that it's a shiny gray jet? So you need to find exactly what is your destination, what is your flight path, and that's what advisors do. So I really enjoy this conversation because it does provide that mental stimulation that people need, and then the understanding of the markets and what to expect, managing their own expectations. And at the same time, it just really highlights the value of working with a good advisor to have that customized plan to make sure that you can navigate these turbulent markets and you come out of the other end and keep focus on that plan. The definition of investment success, in my view, is not how did we do last quarter? How did we beat the benchmark? Did my fund outperform? That's in my view, that's a very short-sighted way of defining success. To me, the definition of success is how are we on track to meet the goals? It's possible that part of that, it might be to be off track. You might actually have some times when you're down, and that might be part of the plan, because if you if you fly from LA to Hawaii, at some point you might get off track, and it's fine. It's because the winds are blowing, and it's fine. You just get back on track. It's just when you get to land, that's when you have to have the precision. When you retire, that's when your portfolio has to be a lot more precise. So to me, thanking people for taking the time to listen. Hopefully they got a little bit of understanding about what's going on in the market. At the same time, really be careful on how you define success, and do sit down with an advisor and build a financial plan that is custom to your needs and also your preferences.
Excellent. Apollo, thank you so much for being a guest on Sound Retirement Radio.
It's great fun talking to you.
All right, take care.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.